A very good morning to Success Financial Analyst Berhad, Finance Director. Today we are going to present the finding for Padini Holdings Berhad financial performance in this video. To give out our best advice for the potential investor and the client, we have done a comprehensive analysis report based on the financial position and the background of Padini. Our team consists of 5 members, including me, Yang, Jay, Xing Yao, Xiaotong, and Yushen.
I will be introducing the Padini Holding Berhad, one of the most prominent fast fashion brand in Malaysia. Founded in 1971, began to operate a small women's clothing business. Over time, it has successfully transformed into a wholesale clothing business and listed as a public company in 1995. It had grown to 2.5 billion as of 30th June 2024. Until today, it consists of 9 subsidiary brands such as Padini, PTI, P&Co, Vinci, and so on, that are targeting different age groups of consumers. The mission of Padini Holding Berhad is to exceed customer expectations and their brands promises, focusing on creating fashionable, affordable, and high-quality products. With outstanding service, also Padini always adhered to the goal of being the best fashion company ever as their vision.
Next. The company's core business activities include managing its internal brand portfolio through offline and online channels. It is operating multi-brand concept stores and discount stores, expanding its regional footprint in Southeast Asia and the Middle East, and ensuring the quality and sustainability of its supply chain. Lastly, Padini pays high attention to its own financial performance in order to make sure all stakeholders are able to benefit from Padini. In 2024, Padini is able to achieve 22.28 cents in its earning per share and revenue of 1.92 billion. It ensures that their products are high quality and cost effective for the consumers, focus on the profitability and dividend distribution of the company towards the shareholders. Padini also focuses on providing stability of the working environment and condition for the employees, and always keeps an eye on the compliance and ensures the company operates legally with laws and regulations. Next, we'll be moving to the 5-year trend analysis to evaluate and understand the performance of its financial position before making a decision for investors to invest. This analysis will be using 5 essential financial ratios, including the gross profit margin for profitability, quick ratio for liquidity, inventory turnover ratio for efficiency in managing its stocks, interest cover ratio for long-term solvency, and the earnings per share for the market perception. For us to provide a comprehensive analysis, we have selected Bonia Corporation Berhad, which is a competitor of Padini in the same industry and also targeting the same market in Malaysia, selling fashionable products. By having the comparison, able to gain insights towards the industry and have the understanding of how well is Padini doing. First and foremost, we will discuss the gross profit margin for revenue and profitability. Gross profit margin analyzes the profit after deducting the cost of goods sold, which further indicates the net sales of the company and assesses its ability to generate profit from its core business. This margin helps companies to shape their marketing strategies, sales strategies, and operating expenditures. For this ratio, Padini shows the downward trend overall after having a small uptrend during 2020 to 2023. It indicated that Padini is influenced by factors such as MCO caused by the COVID-19 pandemic that lead to shop closure and low revenue in 2020 to 2022. In 2022, it started to rebound when the economy reopened and consumers started to resume physical activities. But Padini faced the inflation issue after the pandemic and clearing inventories, which led to lowest revenue in 2024. However, we can see that Bonia Corporation Berhad were experiencing the same trend during the pandemic, but having just a slight drop in 2024, despite the global inflation and increasing business costs. This ratio in 2020 to 2022 reflects that Padini actually has the resilience and business action plan to maintain its revenue in a challenging period, although it will face some small losses. Thus, the revenue performance of Padini needed to be monitored in the future in order to ensure the management level made some operating changes to increase the value of Padini.
Now, let us look at the liquidity ratio. We will be analyzing the quick ratio for both companies. Quick ratio measures the Padini and Bornea ability to finance short-term debt without relying on inventory and prepayment assets. It assesses the company financial health and providing stakeholder with information. From the chart, we can see that Padini and Bornea were experiencing the uptrend in their quick ratio. Padini had a strong liquidity position, which increased the quick ratio from 2.52 to 3.23, indicating the financial stability and cash management. As Padini has been regularly reviewing measures to reduce short-term liability, increase cash on hand to provide enough liquidity during the low cash inflow period due to the economic uncertainty. It makes sure that the supply chain will be operating as usual and avoid situations such as unable to pay back the loans or towards the supplier and employees. Similar to Padini in 2024, the quick ratio of Bornea increased after a slight drop, mainly caused by the increased lease liability from new boutique launch and lease renewal. Overall, both companies exhibit financial stability, high liquidity. Just that Padini has stronger liquidity, which averaged above 2 to 1 throughout the 5 year compared to Bornea. It shows good management towards its short-term obligation and cash management in order to respond to unpredictable situations. Next, we will be discussing the efficiency of both companies using the inventory turnover indicator. For Padini and Bornea, this ratio reflects the effectiveness of their operational strategies and the demand for their product. In 2022, we can see that Padini ratios increased significantly to approximately 140 days. The increase of number of days in inventory turnover underscored the significant impact of the COVID-19 pandemic on retail operations. During that time, government have implemented rules like social distancing and MCO to control the pandemic. It's temporarily suspending physical establishment for non-essential selling, leading to inventory accumulation in Padini. In 2023 to 2024, the inventory turnover of Padini had risen, suggesting that the company had cleared its old stock and adjusted to meet supply chain uncertainty. In contrast, Bornea, like Padini, also experienced retail disruptions due to the pandemic, resulting in a peak inventory conversion time of 230 days in 2021. The ratio improved to 149 days in 2022, but increased to 209 days in 2024. It's indicating slower inventory conversion due to luxury brand product with longer selling period and larger profit margin. Therefore, in comparison, Padini has a lower inventory turnover ratio, which shows that Padini exhibit more agile and adaptable inventory management strategy than Bornea.
Next, long-term solvency is also one of the areas that investors are concerned about. We will discuss the interest coverage ratio, which is determined by dividing profit before interest and tax by finance cost. It is an important indicator that enables investors and creditors to estimate a company's borrowing risk and its financial stability. During the period from 2020 to 2024, the interest coverage ratio of Padini has experienced a dynamic evolution, which may be attributed to the adjustment in operational strategy and broader economic conditions. Padini's interest cover decreased from 5.11 times to 4.51 times in 2021, which is lower than Bornea's interest coverage ratio of 5.21 times. Bornea's interest coverage rising in 2021 indicates that the company is actively negotiating borrowing arrangement to preserve manageable interest payment and effectively avoid additional borrowings. And the decline of the Padini's ratio is due to the impact of the COVID-19 pandemic, which result from the closure of all branches and supply chain disruption. In 2022, Padini's interest coverage rebounded to 11.6 times, which proved that Padini's recovery effort to respond to the economic uncertainties. It has reached a peak in 2023, which is higher than Bornea's ratio. However, both companies experienced a drop in 2024, but Padini was still slightly favorable. The decrease in Padini ratio is due to an increase in interest expenses on leases liability from 13 new stores opened in 2024 and higher purchase borrowing for warehouse automation. To conclude, Padini has a stronger market position, larger customer base to manage solvency more effectively compared to Bonia. The last financial ratio is the earning per share, which help investors understand the net profit gain per share and reflects the profitability of the company. Based on the chart, we can see that the trend of both companies are similar, with an uptrend until 2023 and a drop in 2024. In this ratio, Padini shows its profitability has been increasing in the first 4 years caused by the economic reopening, decrease in the operating expenses, and reduction in security personnel in 2022. After that, the earning per share reached the peak due to the full resumption of business operation and experienced a slight drop in 2024, led by the depreciation increase due to the opening of new store and renovation. Padini's earning per share is influenced by its stock clearance plan, new store openings, and global inflation rather than sales decline, as per the company's operational plan. These external factors will influence the company in the short term, and it takes a little bit of time for the company to adapt and solve the problem in order to perform well again. Therefore, the company performing slightly unfavorable in the short term does not indicate that it will continue to decline in the future.
So coming to the conclusion, Padini shows the strengths of strong liquidity and financial stability, effective inventory management, and resilient in solvency in its financial performance. Now we understand that Padini and the retail industry were experiencing external challenges such as pandemic and rising inflation costs, which increased its operating expenditure. However, we know that Padini is doing well in its short-term liquidity and managed to control their cash management with the ratio of average above 2:1. Another strength is that Padini's interest coverage reflects resilience in the result. From what we mentioned above, the growing financing costs may affect the probability, but since Padini has a stronger customer base and better market position, Padini could manage solvency more effectively. Then we mentioning about the efficiency. Padini's inventory turnover greatly improved in 2022 but declined in 2023 and 2024. This suggests that Padini is able to clear its stocks and offers a range of products to satisfy customers' demand, which should not be considered a big issue for inventory turnover. Hence, Padini is seen to be effectively managing its inventory. To withdraw the weaknesses, a few areas need investors to focus on, as the investment appeal is weakened by the decline of profitability and deteriorating investment sentiment, suggesting that investors should regularly monitor key indicators like earning per share, growth profit margin, and as well as the external market conditions. Likewise, Padini should improve cost management or adjust pricing approaches to increase investors' confidence. Next, earning per share follow the same trend. The dropping in 2024 might lose investor confidence. Besides, Bonia's earning per share is also declining in recent years, but Padini is slightly more favorable for investing. The efficiency in asset utilization is also one of the areas that investors need to pay attention to. In short, we would recommend the success financial analyst Berhad's financial director to invest in Padini, since Padini has stronger liquidity, effective inventory control that promote the financial stability and efficiency. Furthermore, the operational resilience and solid foundation enhance the long-term growth. After deciding to invest in Padini, the investors should also concentrate more on the future's Padini revenue performance and the external risks in the economy. So coming to the end of our presentation, thank you.